weekend. Let me also invite on the show Rupen Rajguru, Head of Equity Investment and Strategy at Julius Baer on the show now. Rupen, afternoon, and thanks for joining in. Just purely going by the numbers, the kind of reaction we've seen to earnings, take a look at Polycab or Astral. The numbers look good. These are large mid-caps. There's a lot of investor interest in them. But the stocks, despite good numbers, corrected. And then on the other hand, you've got numbers like Havells, where the earnings have been disappointed and the stocks have been under pressure. We've hardly had any mid-caps reacting positively to the numbers or which are higher post their numbers. What does that tell you about the entire market mood and the setup right now? You're on mute, Rupen.
Sorry. Hi, Reema. Afternoon. So this is the classic case of, sell on news. So all the companies which you mentioned, while the numbers were really probably in line with the expectation, but let me tell you, the expectation itself was pretty high. And on top of it, the valuations of these companies also were trading at a reasonably high or probably at an all-time high level as far as valuation is concerned. So what happens typically, markets do tend to anticipate, the future in the current price. So from some of the numbers, when numbers were not good, the expectation is typically that the future, probably the worst is there, and going ahead, the market will be rewarding that stock. So that's a classic way typically market behaves, Reema. This is not for the first time we are seeing it. Probably we have seen this theme playing earlier as well.
No, it's played out earlier, but the question is, does that mean that since everything appears to be priced in, the good news, there is a bit of a correction which is imminent now? And what could that be? How long would it last? What could be the extent of this somber mood in the mid-caps?
There is hardly any somber mood per se, Reema, and I'm sure a lot of guests on your show would have talked about the impending correction in the small and mid caps. And if we just pause for a moment and let's go back, say, 18 months, wherein assuming if we had a perfect foresight and somebody would have told us that in next 18 months there will be two wars. The US will see the fastest ever pace of rate hikes from almost 0 to 5%. What would you do? I think the big question would be, okay, we'll stay away from the risk assets, and if at all we want to be, we'll stay away from mid caps and small caps. But all those things have played out, and what has happened? Probably Nifty is up actually 10+%, and mid and small caps are up 20-30%. So despite all these news flow, they have done phenomenally well, and they've all got significantly re-rated. So here again, it's not purely that liquidity which was driving them, but also the numbers. As some of the companies you mentioned posted quarter-on-quarter very strong numbers. But beyond a point, the re-rating can only take you so much, right? And then it has to consolidate. So net-net, just to prove a point here that at the current juncture, what I probably also, when I was in your channel last time I spoke, that mid and small caps will have to take a pause. It can also correct from here because they have gone up significantly, and probably at this juncture, large caps are.
All right, Rupen, just stay with us. We have Lotus Labs, the numbers that are flashing on the screen, and prima facie, this appears like a big miss because the EBITDA number we were factoring in is closer to around 300 crores. And the EBITDA number that our team has calculated, well, it's a little sub of 200 crores approximately. So I think we need further clarity out there. But prima facie, both the EBITDA number and the net profit number, they're much, much lower than what we were working with. The revenue number as well, that's a miss of close to around 150 crores as well. So 150 crores, that's a 10% miss on the top line. The EBITDA number is a bigger miss. That's a 30-40% miss in comparison to what we were working with. And the net profit number as well, much, much lower. So it appears it's a top-down miss, but we need to understand why at the EBITDA level there's such a sharp fall. Is there any kind of one-off? For the time being, the stock is not reacting much. It's down only around 1%, But these numbers, prima facie, look very, very disappointing. I think Ekta will try to join in fact, give us further clarity on that one. Rupen, one set of numbers that has come out is from the IT pack. This morning, we had a lot of mid-cap IT companies that were talking to us. So it appears decision-making is a little bit slow, though the order pipeline looks quite good. How would you approach them? IT as a space, will you go with the mid-caps, or do you see further safety in the large-cap names?
Hi, afternoon, Nigel. In IT, there has been a perfect, conundrum wherein large caps actually have, continuously probably disappointed on their guidelines, or rather the guidance, wherein for last 2 quarters we have seen large companies cutting their guidance, and at the same time the overall TCV, that is the total contract value, is probably at its all-time high. So somewhere there is you have contracts, but execution is not happening. Here what we believe is that apart from the total contract value, and also some of the smaller contracts or some of the other flow, as they call the flow business, is not coming as much as what the companies would have expected, and hence I know you are seeing this slowdown. But here probably I would say we have seen this kind of cycle also playing out in particularly in large cap IT companies, wherein I think now scale is becoming a probably hindrance for the kind of growth which we are used to in that. But from our perspective at this juncture, we would still prefer a large cap IT companies, because they have not probably on valuation they are slightly lower than what they were 2 years back, and in line with their long-term averages. In mid cap, clearly I think there are various types of companies, and some of the companies, the product-related companies, ER&D companies, we are constructing, but probably I think the valuation, we would prefer a better entry point into getting into some of these things.
By the way, this is the 5th consecutive quarter when Loris has missed expectations. While in the Q1, I was just reading up about Q1 margins had come in at 14%. They were a multi-quarter low. Yeah. At that time, the company in the call guided that margins in Q2 will improve. They have improved, 15.3 versus 14% on a sequential basis. But clearly, the street was expecting a much sharper recovery, because margins historically for Loris Laboratories used to be much higher. There you have it, 15.3 versus 28.5. And if you pull up a 6-month chart of Loris Labs, you would see that just prior to Q1, the stock was hovering close to about 600 rupees. Then came that fall in. You can't really see it. If you can. Pull it up from, say, July onwards, you would see, at least over here, it shows the stock was closer to about 600. It went down to levels of 300 post the disappointment in Q1. From there, it's recovered. But again, there is that miss in Q2.
Absolutely. And it looks like there's no durable recovery in sight in terms of the overall business, and the market doesn't seem to have too much of patience with that right now. Stock is, of course, sputtering along, % or so lower. We'll get more on that in just a bit. By the way, the market as well is trying to fight back real hard, but there's no meaningful support from the banks. Bank Nifty is absolutely flat. The Nifty is not too far away from the day's low either. So it seems this last half an hour, the bears seem to be very clearly having the upper hand. There you go. Nifty Bank, no sustainable up move or sustainable bounce we can see. And the Nifty as well, of course, is feeling the heat because of that. Rupen, hi. I just wanted to get your thought on consumers, and not so much of the discretionary, but more the regular consumption play. I mean, whether it's your FMCG or the more mass consumption, so to speak. Companies have been reporting fairly lackluster volume growth. I mean, there's no lighting up the charts, at least just yet. How are you positioned on the sector?
Yeah, hi. Afternoon, Surabhi. Yes, you're absolutely right. The volume growth story for the staples have been tepid for now 3 quarters. And I think one of the reasons why they all were ailing is because of the rural consumption, which has been quite lackluster. What we believe going ahead, while this quarter also, if you see the earnings were hardly the low single-digit volume growth we have seen. But at least what we believe, the rural consumption should finally pick up. Now we already saw a couple of days back, the MSP on wheat was hiked by 7%, probably the largest hike in 12 odd years. And as we are like 7 months away from the general election, and we would definitely see the government, which was very much focused on capex, probably now will spend, I think, incrementally more amount of money into giving it in the hands of the people. So we might see some bit of rural recovery coming out there. And also to add it up from a purely stock market perspective, if we get into more uncertain global environment, FMCG stroke staples would be a good hiding place. So while on a fundamental basis, on a long-term basis, we are not very positive on them, but purely on a tactical basis for next few months, considering the global uncertainty as well as incremental delta for them, once the rural recovery comes through, this segment can do well for next couple of quarters.
Okay, all right, Rupen, appreciate you stopping by and filling us in with your views. Wishing you a good Friday evening, a pleasant weekend ahead as well, and we look forward to having a chat with you. Hopefully by then, some of these headwinds for the markets could have cleared out. Well, for the time being, we slip into a short break. On the other side, we'll get D Street chatter. Nimesh will be joining in to give us his inputs. Our technical experts as well will be back with us.